The provocative path. Mastering the Finnish tax labyrinth. Listen closely. In Finland, the land of high costs and even higher social trust, there are two ways to deal with your tax burden. One is for the naive, the other is for the financial master. The critical distinction. Avoidance versus evasion. Forget what you think you know. These words are not synonyms. They represent the razor-thin line between a life of audacious financial freedom and a cold, expensive conversation with the police. Tax evasion, the crime. This is the amateur's game. It's illegal. Lying on your return, hiding cash, falsifying receipts. Evasion is breaking the law. It results in fines, penalties, and jail time. It is a direct, foolish confrontation with the state. You lose. Tax avoidance, the high art. This is the legal chess match with the tax administration. It is the brilliant, meticulous use of every single deduction, credit, loophole, and structural advantage the law explicitly provides. Avoidance is mastering the rules to legally arrange your affairs so your liability is minimized. It is not a crime, it is economic sophistication. 2. The direct assault. Weaponizing deductions. Your first step is to aggressively reduce your taxable earned income, salary, which is the most brutally taxed category, up to 55% marginal rate. The household deduction kotitalousvähennys. The state is begging you to spend money on home services. Oblige them, and cut your tax bill. The eligible work, cleaning, childcare, yard maintenance, and most importantly, renovations and repairs at your home or holiday home. The strategy. Use a registered company and claim the cost of labor. The coup. This is a tax credit, reducing your tax bill euro for euro. Couples can double the benefit, claiming up to a combined maximum, e.g., typically €3,200 total tax saving, simply by strategically splitting the costs on their returns. The home office deduction tilwonavahennies. Your kitchen table is now a subsidized workspace. Claim it. The low effort win. Claim the formula-based deduction up to approximately €960 for full-time remote work without any receipts. This is free money, requiring only a declaration. The high-stakes score. Claim actual expenses, rent, maintenance percentage, furniture, high-cost equipment if they exceed the formula amount. Buy your work-related chair or monitor for under approximately €1,000 and write off the entire cost in 1 year, creating an immediate deduction against your high-taxed salary. 3. The structural revolution. Converting labor to capital. This is the apex strategy. Exploiting the difference between high-taxed progressive earned income, up to 55%, and the flat, lower-taxed capital income, 30% or 34%. The tool. The private limited company, Osakeyhtiö Oy. The strategy. Instead of paying yourself a huge salary, pay a balanced mix of salary and dividends. Your company pays only 20% corporate tax on profit. The remaining profit is distributed as a dividend, which is subject to highly favorable tax treatment, partially tax-exempt or taxed at the lower capital income rate. The result? The total tax burden, corporate tax plus personal dividend tax, is often significantly lower than paying yourself a full salary, effectively converting high-taxed labor reward into low-taxed capital income. The shield. Reinvest the profit inside the company, where it grows, sheltered by the 20% corporate tax rate, deferring the high personal tax rate until you choose to distribute it. IV. The debt weapon. Generating tax losses. Stop seeing debt as a burden. See it as a deductible expense that lowers your tax base. The loan type. A loan for the production of income, typically a mortgage for a rental investment property. The power. Unlike an owner-occupied home loan, which is no longer deductible, interest on a rental loan is 100% deductible from your capital income, rent, dividends, capital gains. The coup. The capital deficit. Structure your finances so that your deductible expenses, especially interest and maintenance, exceed your rental income. This creates a negative capital income, a capital deficit. This deficit is first deducted from all other your capital income, e.g., profit from stock sales. If a deficit remains, 30% of it is converted into a direct tax credit against your high-taxed earned income, salary. You are weaponizing debt on an investment property to legally lower the tax you pay on your daily wage. The conclusion. The Finnish tax code is an invitation to the financially astute. The goal is not to hide, but to optimize. Play their game, but play it to win, and keep what is rightfully yours.